What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. Let's switch gears a little bit and talk about entity structures. For someone who has a portfolio of commercial properties, so me specifically, I'll have one LLC for each individual property. So
Awesome.
what structure typically wins for your normal commercial real estate investor? Could it be an S corp or anything different than that?
Okay, so let's start from what you just said last. I say this to clients. If I see real estate portfolio, meaning if you have portfolios of real estate that is buy and hold inside an S corp, honestly, the CPA should be charged for my practice. Is that serious to me? Because it's such a dangerous thing to do, because you're putting your client in a place where if he or she has to pull that property out or do some other things, the tax consequences are very severe. So when you're talking about entity structure, typically, in most cases, I am going to be recommending, depending on a lot of things, depending on, hey, are you the only owner of this LLC? Their fellow investors? Is there a spouse? What's your game plan? And all that kind of stuff. There's a whole lot that comes into making that decision of what the right entity structure is. But 9 out of 10 times, when it comes to real estate, you want to put real estate into an LLC that is filing taxes, preferably as a partnership. If there's a husband and a wife, or if, many times, even if it's just one person, I can still create a partnership by getting you to set up a management company, and you give the management company 2% of that LLC. Okay? So the LLC is filing taxes. And you said something that's music to my ear. You put each property into one LLC. I can't tell you how many times I am beating myself over the head trying to convince some clients on the need to do things like that. The best thing to do is keep a wall around each property, right? Now, it doesn't mean you are going to be filing God knows how many tax returns. No, 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 no. If you create your entity structure in the right way, you have one LLC for one property, one LLC for one property. You could have 14 LLCs, but you can follow all of them up to a holding company. Preferably for me, I prefer Wyoming as where clients should have their holding company. So at the end of the day, all of those properties, right, from a tax return perspective, there's still one return that is being filed for them. But from a legal protection standpoint, there is one LLC for each of the properties. So what happens to property one does not bring property two or four into problem. So yeah, that's my go-to. That's my game plan. But again, it's not a one size fit all. This is why you should be talking to people who understand this. You just talked of entity structure casually because you know what you're talking about. But many CPAs and many lawyers, unfortunately, cannot even read an entity map.
Now, along those same lines, where do trusts fall into asset protection and tax efficiency? Is it very similar to an LLC, or is it a different ballgame altogether?
Very different ball game. To start with, there are different types of trusts. Very broadly, you can be looking at it from revocable and irrevocable. Okay. Now, with the new estate tax law that is really very, 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 very generous, there has not been the need for too many people to be doing irrevocable living trusts. So what most people are doing is revocable trust. But let's get this clear. Most of the times, the revocable living trust that everybody is forming is not for asset protection. It is not. Most revocable living trust is to make it easy for every one of us when we pass on, for our beneficiaries to step into our shoes and act like it is we. That's what most revocable living trust stands for. Okay? Because it allows you to avoid probate. Okay? Instead of your kids having to do a fire sale on one property to pay lawyers and pay the court and go through all that hassles, and for real estate professionals, you find that they tend to have properties in different states. Now, without a revocable living trust in the state that you are resident in, you're going to find that you are subject to the laws of as many states as the properties are located. So you want to avoid all of that. Okay, that's where revocable living trust comes in. And if you hear that word revocable, means hey, as the grantor or the settler, I can change the trust any day, anytime I want, as long as I'm still alive. Now, when the moment I die, that trust automatically changes from the second that person passes from a revocable to an irrevocable. Now, talking about tax efficiencies, oh, absolutely. There is a place for irrevocable trust. It just depends on the taxpayer. If somebody is making a whole boatload of money, all right, and you want to try to shift some of this income from them who is in a high tax bracket to some other people like their grandparents or their parents who have low income or even some of their kids, right? Then that's a place where you may want to set up an irrevocable trust to become owners of some percentage share of the business. Again, to your earlier question about an LLC, that's where the LLC is really cool. Okay, because it's with an LLC, you could do a lot of magic. You and I can be owners of an LLC, and I get 90% of the profit. And we write the rules in a way that, you know what, you getting 1%, even though you brought in all the money, and I'm getting 99% or vice versa. So, yes, there is a place for it. So, when you're talking to a CPA about trust, you better be sure he or she understand the types of trust, what your goals are, so that you can achieve both the asset protection for the irrevocable living trust. Absolutely. They are tax efficient. They are great for asset protection if it's a domestic asset protection trust. Okay. There are like 29 states in the United States today that now allows for domestic asset protection trust. So there's a place for that. But this is why, again, you got to be talking to the experts.
Yeah, I love that. So there are a couple other methods or creative ways in the tax world to avoid to become tax efficient, right? We were just mentioning trusts. Now there are also, from what I understand, a couple other trusts. You have your Delaware statutory trust, you have a deferred sales trust, both are DSTs, so you have to specify which one. Then you have 1031 exchanges, 721 exchanges, and I'm sure there are plenty more that I don't know about. But just in particular, let's focus on the two exchanges and the two trusts. When does each one of those make sense, and which of them are the most overrated?
Are you talking of the Delaware Statutory Trust and the Deferred Sales Trust?
Yeah, so we're going to compare the Delaware statutory trust with the deferred sales trust, and then we can move on to the exchanges as well.
Okay, so with the two DSTs, it's always going to depend on what the taxpayer's situation is. Honestly, there isn't one that I would consider superior to the other. The one thing I would say to you right here is, again, expertise is needed just because these two DSTs are closely scrutinized by the IRS. So when you use them, okay, you want to make sure they are properly done and properly documented. The IRS really is not a fan of any one of them. I can't tell you that, oh, a deferred sales trust and a Delaware statutory trust, this one is superior to the other. I think, again, it boils down to, look, the clients, I mean, the tax accountant knowing which of them is most appropriate, right, for your client and be able to say, okay, let's run with this. All right. If I have a client as an example, and I have one that is cooking right now, he's likely to have almost a $7 million gain from the sale of a business. All right. The capital gains, because that client is in California, the capital gains is pretty significant. He has a choice of either doing something or doing something like a deferred sales trust that allows him to bring down the 33%, 20% federal, 13% California down. Instead of 33% of that gain going away, he's able to bring it down to like 8 or 9%. Okay. It's the DST, one of the DST that will make that possible. All right. But it has to be well structured. Okay. you cannot be structuring that when the deal, there's already a letter of interest or all that kind of stuff. You want to make it really clean. So my point there is I don't consider uh, I don't consider anyone superior to the other. You got to look at your client's case here and say, okay, with this work, what is the audit risk? Because at the end of the day, if you remember at the beginning of this call, I kept saying to you, whatever we do, it has to be legal, it has to be ethical, it has to be moral. It's so important. I'm not a CPA trying to die young, okay? But I'm saying the tax code is such a gift if you're working with a good CPA.
Love that. Yeah. So a lot of us understand and know what 1031 exchanges are, right?
Mm-hmm.
It's a way to defer taxes onto the next property. But a lot
Mm-hmm.
of us have not heard about 721 exchanges. Could
Mm-hmm.
you give us the simplified version of what a 721 exchange is so the normal person would understand?
So let's first of all answer what a 1031 is. 1031 is named after that code, okay, which just says, hey, you could sell something like kind replacement and you defer the taxes. Again, there are maps. But the 721 is also named after the IRS Section 721. This allows a real estate owner to contribute property to what is called an umbrella partnership REIT, real estate investment trust, in exchange for operating partnerships units. We call it OP. So thereby you are deferring capital gains at the time of contribution. All right. That's what your 721 is. What your 721 does is some of the key features of it is it converts real estate into operating units inside a REIT operating partnership. And I know I'm flying 50,000 feet, but I don't want to go there because we'll be here forever. It allows you to defer capital gains at the time of exchange. Again, it's not eliminating your gains, you are deferring it, time value of money. You give up the direct property ownership, okay, in exchange for units. However, your operating units are not liquid. Typically, you have a lockout for like a year or two, okay, before you can convert that into the REIT shares. Now, once you've converted to your REIT shares, the deferred gain is triggered. Again, see, these are very deep things you ask into. And so for somebody who is telling me you don't know much about taxes, you sure do. Okay. If you were talking to some CPA who doesn't know what they are saying, they will be stumped with your question. You were trying to pull that over me. So, so I'll tell you, a 721 is not bad. So again, my answer to you is there's no superiority here. It's always going to be what fits the client's pattern. What is this client trying to achieve? Do you understand? Unlike the 1031, you don't have other 45 days slash 180 days deadlines, okay? So these are the things that a good CPA needs to look at and say, all right, this will work, this will not work.
Yeah, yeah. I mean, you answered that beautifully. It gives me a better under. I've heard of it, and I kind of understands like the general overview of it. But as
Mhm.
soon as you get more granular, it becomes a lot more complicated, right?
Yeah, yeah. It gets more complicated. Both of them are tools. Both of them are tools, right? I mean, if you take a 1031, for example, when you eventually sell, you trigger the gain. Okay. But for the 721, when that operating units, right, convert to your REIT, you have triggered gain. So you want to say, okay, is this what you want to do?
Yeah, 100%. I love that. You've talked about, and we've had, one prior example here about ultra wealthy entrepreneurs paying effectively zero taxes legally,
Because
with all this
that's
magic,
important.
right?
Yeah.
Outside of some of the strategies that we've talked about, are there any other strategies for that entrepreneur, that avatar, any other strategies from your playbook that CRE investors can actually use or deploy today?
There are lots of strategies. When you ask that question, I have no one answer for you.
Well,
Again,
how about you give me your favorites?
I understand, and I'm being honest here. I don't want to sound magical. I don't have a favorite. I am always, first of all, going to drive my recommendation and my tax planning from, first of all, understanding what is the goal of my clients. Once I understand that very well, that this is the client's goal here, Then I can begin to reverse engineer into which of these strategies. You just put 1031 versus 721, to me, two different things, but they have features that are similar. Okay, so there are lots of things, but what is the client seeking to do? Many clients hate to pay taxes. The ultra wealthy rightfully don't want to just give the money away to the government, okay, because they feel they are more efficient in the use of the money than the government may be. Whether that is true or not is political. I'm not going to go into that. So my job is to always look at the client's situation and say, all right, we have milked your real estate strategies as much as we can. There are many other strategies that can still allow an investor to generate losses that will be active. Okay? Because of the bonus depreciation you talked about earlier. Because when we talk bonus depreciation, it's not only applicable to real estate, it's applicable to so many things. I mean, we use a lot of strategies. We go to the solar tax credit. We look at things like equipment lease. A client puts in $1 into an equipment lease. There is a borrowing of $6. So the person is getting $7 to one and they're getting that deduction. The important thing is ensuring that they track their hours, make that 100 hours that the government wants, make it a real business. Because if it's not a real business, the government is going to come back and say, this is a tax shelter. You don't want to cross that line. I'm not into the tax shelter world, but there are many tools out there. I wish I can tell you this is my favorite. No, I don't have any favorite. When I'm looking at strategies, I'm looking at like 4 or 5 things. I'm asking, okay, is this strategy sound? Sound from the perspective of, will it pass the IRS test? Whatever the part of the tax code, okay, that strategy is anchored on, will it meet the IRS test? Is this a tax shelter? Tax shelter mean, hey, you know what? All this arrangement is just done just because you're trying to avoid taxes. We don't want that. We want a real business. Okay? The tax benefit should just only be an added bonus. So when I'm, you know what? There's a whole lot of TikTok, YouTube, and everything out there. It's almost a joke when people are looking at those things. And I'm like, you cannot be advertising a strategy and saying, oh, this is a strategy to reduce taxes. Because if that's the main purpose, you're just going to call attention to yourself and from the IRS. Because that's a tax shelter. There has to be a genuine business and economic reason to say, this is what we're doing. And then it's giving tax benefit as a side bonus. Okay.
Yeah.
So we look at that. We look at the audit history of the strategy, whether or not some other people who have used that strategy has been audited, and if they have been, what was the outcome of the audit? Not just what was the outcome, why was the outcome favorable and why was it not favorable? Okay. And in some cases, if we're not too comfortable, we get a sound tax law attorney firm to give us a tax opinion letter. I mean, there are times I literally get on a plane and I travel to sites, locations of strategies because I don't want anybody pulling any wool over me or my clients' eyes and give all these great things on social media and then it turns out to just be smokes and mirrors. There's just a whole lot of Ponzi scheme out there. So as I'm talking to you now, this is the month where I'm going through all the strategies that we will be using for our clients this year. I can tell you, it's not every one of them we're going to recommend. I may end up with like 20 strategies. I may end up only showing 7 to my clients because those are what I'm comfortable with. That's why we've been able to be in business for 19 years, going to 20, and still be alive.
Perfect. But you touched on IRS audits and whatnot. Luckily, knock on wood, I have not been audited. But with the IRS ramping up audits on like high income filers or businesses in general, how do investors stay aggressive on their deductions without raising any red flags?
I wouldn't use that word even aggressive. I don't think aggressive is the word for it. I see most times where people use that word aggressive, especially fellow CPAs, they call things aggressive when they have no knowledge about it. I'll give you an analogy. If you're not a great swimmer, you have no business going to the 8 feet or the 12 feet section of the pool. That would be aggressive, right? But if you are a great swimmer, you want to go to the deeper end of the pool. If you're not a great swimmer, you want to stay by the 2 feet and just be putting your leg out there. So that's the way I see the tax code. And that's again part of why you started this meeting by saying what's the difference between a super expert in one area and a generalist. That's why you got to be sound. Okay. So what was your question? Aggressive or no aggressive?
With the IRS like ramping up audits, how do investors, along with their CPA, real estate CPA in particular, keep deductions aggressive without raising any red flags? Now, what you're saying is that obviously you have to have the expert there, and they have to be comfortable with whatever strategy plus deductions. Am I right?
Yeah, yeah. So that's that. But again, I don't know if there's that word aggressive. Is the tax code? The tax code is a roadmap. It's an incentive for the government to get you to behave in the way the government wants you to behave. If you are a superstar in any game, you still follow the rules. I don't care if you are LeBron. If you don't follow the rules of basketball, you get to foul out or you get kicked out by the ref, right? So it's no different for taxes. If you are a good NBA follower, you will find that the OKC Oklahoma Thunders, they are aggressive with their defense, right? But they have mastered how to stay on the aggressive side of defense without necessarily fouling. Okay, so that's where the knowledge comes in. The knowledge comes in. But to answer your question, oh my God, documentation, 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 documentation. No documentation, no deduction. Okay, now documentation needs to be happening as the event is occurring. What happens to most people? They undermine what their CPA is telling them. They don't document. Then when the IRS audit later comes 2 years from today, they are trying to go back and recreate that documentation. It's bad. I mean, take something as simple as business mails. If I'm having a meal with my spouse and our kids who are part of the business, it's a business deduction, okay? Because we are discussing business there. I don't care what you think, okay? It's a business meal. But is there a receipt that the system has? Yes. Do you see the names of those who were in that meal? Yes. Do you see the things that were discussed in the course of us having that meal? Yes. That does it. BOND. It's a business purpose. It's an ordinary deduction. It's necessary for the business and it's documented. So that's why I said, I don't know about the word aggressive. It's about knowing the rules, playing by the rules.
I love that. I love that. Well, Michael, this has been incredible. I've learned a lot here. I
Thank
don't have
you.
any other questions for you. Before you leave us, is there any social media links or websites or resources that you want to share with the audience if they want to get a hold of you?
Yes. So the first thing I want to say is we just launched our real estate tracking app. And I want to put that out there. So if you want to write this down, it's TRACNEST. It's an app, TrackNest. There's no K in it. It's just T as in Tom, R as in Rainbow, A as in Apple, C as in Charlie, N as in Nancy, E as in Edward, S as in Sam, T as in Tom. You can check the website is tracknest.com, but the app is on the Google Play and it's on Apple. Again, because I've done this work so deeply, so I just got fed up of people not knowing how to just track these hours because we talked about this at the beginning of the show. What qualifies as a real estate professional? So we've built this app that people can use instead of trying to create clumsy spreadsheets and clumsy spreadsheet that you are creating after the fact because there's an audit. But with an app, you are able to log in time, you are able to upload documents and take pictures. It syncs to your calendar. Very wonderful things. In fact, starting next month, for subscribers to the app, I am going to be holding a 45 minutes weekly support. Just allow people ask me questions on real estate like this because the users are real estate users. Now, the coolest thing about the app also, not the coolest, but one of the cool things is when you are a subscriber to the app, you can invite your CPA so your CPA is able to see your time as you are tracking time and all of that. So it's not at the end of the year when you are saying, yeah, yes, my spreadsheet, and then the CPA is saying to you, hey, your hours don't qualify you to be a real estate professional. So I want to ask your your listeners to go check the app out, and we will be giving support. When I mean support from the point of users of the app are going to be talking to me for free, literally, when they talk to me weekly. Okay. You asked some very great questions here today, and I can tell you all of your questions are very relevant to listeners who are real estate professionals. So that will be my first go-to. Check it out, TrackNest. All right. Other than that, you can catch me on taxes@smithcpa.com. Shoot me an email. My assistant will schedule with you, talk with you, and see if we are the best fit for you.
I love that. Appreciate you. I'll have everything there in the show notes for everybody. But Michael, once again, thank you so much for your time. It was incredible.
Thank you. I appreciate talking with you.
And that's a wrap. If you've made it this far, that means you've listened to the entire episode. So thank you. I hope you enjoyed it. And if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.